I had dinner with some mates a few weeks back. A finance broker, a lawyer, a stockbroker, a guy who runs a video production studio, and an insolvency practitioner. It was about an hour in. Steve, the liquidator, said something that pretty much stopped the table. He said, "My phone hasn't stopped since July." Turns out that businesses who were otherwise staying afloat had been quietly borrowing their staff superannuation to stay that way, and just found out that that bank has been closed. And that's what this episode is about. Because here's what I want to give you in the next 20 minutes. The clearest explanation of what Payday Super, which was introduced on the 1st of July this year, has changed. Not the compliance checklist, because you always had that, and not the need to actually pay your staff super, because you always had that too. But what it exposed, and what to do about it when the usual answer isn't available anymore. Because the usual answer was money, and the money's gone. Unpaid super was the cheapest line of credit that has existed in this country for quite some time. No application, no covenant, no security over the house, and no bank manager asking what the money's for. And realistically, at least until recently, nobody chasing you until that quarter closed, and often then some. Now think about what this is. It's an unsecured overdraft that you approve yourself at a rate of roughly zero, with a repayment date that you choose. Now, every business owner listening to this will know at least one business that used it, maybe inappropriately. And some of you will probably know this business intimately. And this is not a fringe thing, but here's the ATO's own data. The net superannuation guarantee gap, the money that should have been going into people's accounts and didn't, is $6.25 billion a year in Australia. And that's up from $5.2 billion the year before. The question is not necessarily the gap, but is also why. 9.3% of Australia's 942,500 employers are carrying a superannuation guarantee charge debt right now. And do the math on that. That's about 87,000 businesses just in Australia. And here's the number that tells you the real story. Of all of those employers carrying the debt, only 7,600 of those have a payment plan. The others are quietly burying their head in the sand and hoping they won't get caught, or digging into their own pockets to dig them out of trouble. So we're not necessarily talking about businesses that got into trouble and put their hand up and worked out an arrangement. We're literally talking about tens of thousands of businesses where the money just sat there doing work in the business year after year. And I want to be careful here, because it's easy to make this sound like fraud, right? Some of it, without a doubt, probably is. But most of it is just an owner who had a bad month and needed to make payroll and paid the wages out of the superannuation cash that was just sitting there and pushed the super back a quarter, fully intending to catch up, and then caught up most of it, and then did it again the next slow month. Nobody makes the decision once and calls it strategy, right? You make it 11 times, and one day you look up and it's like, oh my God, this is structural. And that's the business we're talking about today, right? Payday Super didn't invent a new obligation. You always had to pay superannuation to your team. That never changed, right? But what changed is the timing. And timing is what makes this whole thing, and is what Steve was talking about with the number of businesses now getting caught out of it. Because from July 1 this year, 2026, superannuation in Australia has to be received, and I'll stress that, received by the fund within 7 business days of payday. Not at the end of the quarter, not 28 days after the quarter, 7 business days after every single pay run. And quietly in the background, the rate also stepped up to 12%, which, check your Xero account, make sure it's correct. If you were running 60 or 90 days behind on super, that money wasn't a debt sitting in the drawer. We often used it as working capital. It was in the business doing a job. As I said, catching up on that slow month. And the balance never had to go to zero, because as soon as you paid one quarter down, the next quarter was accruing behind it. There was always a float. But that float, as in Australia, is gone. And permanently. This is the point I want to land the hardest, because I've heard a lot of people talk about Payday Super like it's a one-off hit. And it isn't a one-off hit. It's a line of working capital that's been withdrawn from your business and is never coming back. The penalty structure is where it stops being an accounting inconvenience. If you miss that 7 days, then the superannuation guarantee charge kicks in. It's not the shortfall. It's the shortfall plus notional earnings calculated at the general interest charge, which is 10% a year, plus an administrative uplift of up to 60%, thank you government, on top of the combined shortfall and earnings, plus another 25% choice loading if the money went to the wrong fund. Next year, I published a working example I think every business owner should see. 30 contributions of $120 each, right, which doesn't sound very much, paid late, handle it promptly, pay it, lodge the voluntary disclosure, and the total charge comes to about $40, right? But if you let the same 30 contributions run until the ATO assess them, say 35 days late, and the charge is about $5,695. Now, that doesn't go to that person's superannuation. It goes to the ATO into general revenue. Now, same money, same mistake, but the only variable is how fast you moved. Now, superannuation guarantee charge doesn't sit under a director penalty regime. Now, it doesn't mean it's not a company. It means it's not a company problem that stays inside the company. Unpaid super. The superannuation guarantee charge sits under director penalty regime. Now, we've stressed that. That means it's not a company problem that stays inside the company that you can wind up and pretend doesn't exist. Unpaid super becomes a personal liability for directors. Now, that's why my mate at dinner was describing, right? Not a business in trouble, directors in trouble. Now, the instinct when working capital disappears is to go and find some more. And that's what every business owner does. It's what I do, right? So let's walk in the doors. Okay, first one, the bank, obviously. Cash rate at 4.1%, inflation still above targets, refinancing has tightened up hard. And if you're a service business with no real assets and a patchy 2 years, the answer is probably going to be no. And even if it is yes, it's expensive. Okay. Second one, ATO payment plan, right? They're granting fewer and they're enforcing harder. Director penalty notices and garnishee notices are being used far more aggressively than they were, say, 3 years ago, right? Third option, expensive finance. You could be paying 24, 25% on an unbacked line of credit. Not ideal. That probably costing you even more. And the last one, obviously, just trading through it. But court-ordered liquidations are up 19%. Receiver appointments are up 15%. And here's the statistic that genuinely bothers me. Small business restructuring and appointments actually fell in the first half of this financial year. So that's not businesses doing better. That's businesses waiting longer. Every insolvency practitioner out there, like Steve, will tell you exactly the same thing. Owners holding on until liquidation is the only option left on the table, because calling early feels like admitting defeat. So the float's gone. The bank is shut. The ATO is enforcing, and most people are waiting, which unfortunately leaves only one lever. Now, so if you can't borrow the money, you can't stretch your creditors, there's one place left to get cash, and that is to convert more of what you're already building. Now, I don't mean more leads. I'm not going to stand there and tell a business under cash pressure to go and spend money on advertising. That's probably the worst advice available right now. What I'm talking about is the opportunities that you already have paid for that you haven't finished. So let's go through 4 moves in order to have how fast they are to pay. Now, move 1 is treat speed to lead as a cash flow number. Most owners file response time under marketing, and it isn't, all right? It's a receivables number. Every day between an inquiry landing and someone talking to that person is a day added to your cash conversion cycle. So if you can shorten the sales cycle to the same volume of work, lands cash in your account sooner. Nothing else changes, right? You don't need more inquiries or a bigger team or a bigger budget, right? So one workflow, for example, that we build constantly is inquiry lands, Text goes out in 90 seconds. Task hits the rep. Reminder fires if it hasn't been actioned, and that's it. Now, on one build that took that response time down by almost 391%. Now, that's not a marketing win. It's just something that you should be doing anyway. So the days off the clock between work done and money in. Let's look at number 2. And that is go and get your stalled quotes. This is probably the cheapest money in your business, and almost nobody goes and gets it. I remember a web developer that we worked with a few years back who didn't send a quote to someone who asked for one, and then 6 months later bumped into that guy in the supermarket aisle who then said, "Are you ever going to send me that quote?" But every quote you've sent that went quiet is an opportunity that you've already paid for. The lead cost is sunk. The scoping time is sunk. The proposal's already written. And the only thing that you're missing is a second, third, and fourth conversation that nobody had because everyone got busy. We've opened one client CRM and found almost $412,000 in work that follow-up that never been done. Like no pipeline projection. Real quotes to real people who'd asked for a price and never heard back. So if you're under cash flow pressure this month, that's probably where I'd start, right? Not tomorrow, today. 1 hour. Carve it out. Call some people. Not a campaign or a list. Just pull every quote over the last 90 days that didn't get a yes or a no and start working it. Now let's look at move 3. Go back to your database before you go to the market. Now I'm talking past clients. People already trust you, already know how you work, already know roughly what you charge. Reactivation is one of the fastest revenue channels available to a business that can't spend money to make money, which is exactly the position that we're describing. So there's zero acquisition cost. It's a warm audience already and a really short sales cycle. Right? Even 1 or 2% of those people you'd previously spoken to could be tens or hundreds of thousands of dollars sitting in those relationships that you haven't spoken to for 18 months. Now, move 4 is build the deposit into the sale. Now, don't beg for it after. So payment terms allow, leverage. A business with a full pipeline that asks for a deposit is a matter of process. Clients pay for it because that's just how this business works. A business with an empty pipeline takes whatever terms the client offers because the client you can't afford to lose the job. So same service, same client, all right, completely different cash position. The only difference is whatever the pipeline looked like on the day the conversation happened, and the one that stops it happening again if you see it coming. So here's the part that matters more than any of the 4 I've just described. Ask yourself why Super got borrowed in the first place. It often wasn't greed, it wasn't surprise. The shortfall arrived before anyone knew it was on its way, and so the only options left were fast ones, to borrow from yourself, or borrow from your staff. An owner who can see conversion rates, a pipeline, expected revenue for the next quarter, doesn't get surprised about that decision. They see the gap 8 weeks out when there are still 5 or 6 good options available. Chasing the stalled quotes, run a reactivation, adjusting payment terms, or have an early conversation with their accountant. Visibility isn't reporting nicety, right? It's the difference between choosing from 5 or 6 options rather than choosing from the only one you had, which is no longer available to you. All right, here's the part that's going to sting a little bit. And I say this with respect because I made a version of this mistake myself. Every time cash got tight in these businesses, the owner went looking for money. An overdraft, a payment plan, invoice finance debt loan, the super float. Not once in years did anyone stop to look at the follow-up. And the reason is completely understandable. Money was available. It was just sitting there. You didn't actually need to go and make any more. It was quicker to find $8,000 than to fix why the $8,000's worth of quotes went unanswered. So the funding option won every single time for years. That's what the float was really buying. It wasn't buying time. It was buying the ability to avoid the marketing and conversation question. Payday Super was just looking at the last free option on the table, which means for a lot of businesses, the conversation they've been deferring for 5 years now is happening this quarter, whether they're ready or not. Now, I know a lot of you listening aren't in the businesses I've just described. You're the accountant, the broker, the HR consultant, The advisor sitting across the table from that business I've been describing. So let me talk to you for a minute, because there's something in front of you right now that won't be there in 6 months' time. Every single client on your list with a payroll is in one of 3 states: fine, quietly exposed, or already in trouble. And right now, you don't know which is which. So here's what's going to happen. Some of these clients are going to fail visibly over the next 2 or 3 quarters. And when that happens, there's only 2 versions for you. The advisor who reached out again in August with something useful, and there's the advisor who found out when the liquidator's office called them for the books. Same client, same information available to you both, but a completely different relationship. So here's the campaign I'd run, and I'd run it this month. Segment your client list into payroll exposure. Anyone with staff, weighted by headcount. Build one diagnostic offer with a deadline doing the work. Say a Payday Super cash flow check, right? 30 minutes. Are you actually funding 7 days super out of operating cash, or are you funding it out of hope? Now that conversation goes one of 3 ways. There, fine. And you've just banked enormous amounts of trust for free. They're exposed, in which case you've got an advisory engagement and you can save them, or they're in real trouble and you can make warm introductions to a restructuring specialist, which, by the way, is how you build a referral relationship that sends work back to you for the next decade. If there's one thing on the content side, because I've been watching this closely, every accounting firm in the country published a Payday Super compliance check in June, right? That's content is a commodity now, right? It's everywhere and it's largely identical. But almost no one has published anything about what Payday Super exposed, and that's the wedge I would encourage you to explore. Right? That's the piece that your clients would actually forward to somebody. So if you were listening to this and recognizing this in your own business, the stored quotes no one's chased, the reactivation you keep meaning to run, and the fact that you generally can't tell what the next quarter looks like, that's the thing to fix, right? And it's fixable faster than most people think. That's the work we do at Win More Clients. We go into established service businesses and find the revenue that's already there and not being converted. We build a system that stops it leaking again. So if that sounds like your situation, book a discovery call. There'll be a link somewhere here, right, in the show notes. All right, and we'll spend half an hour on your numbers, and I'll tell you straight away whether there's enough there to it's worth fixing. And if there isn't, I'll tell you that too. All right. One last thing before I let you go. That conversation at dinner stuck me for days. Not the numbers, but the pattern. So Steve said something I keep coming back to me. He said, by the time they call me, they've usually had about 18 months of warning signs and ignored every single one of them because of hope. Hope that they would just get one big client across the line to solve all their problems. It's a bit like gambling. So I've come to him I've asked him to come on the show and walk us through it properly, right? What he actually sees in the 2 weeks before a business picks up the phone, and more usefully, what he sees 18 months out, right? And when that's completely fixable, right? So that's the next one. Don't miss it. Now, go and pull out those stored quotes today, and I'll catch you next time.